Okay. So yeah, looking at select industry, right? Picking the right industry is very important. Picking the winning company, which is the most profitable, even if it doesn't have the highest market share. Within that, once we've checked those two main boxes, we're looking at sound management. So we want management who takes decisions in the interest of shareholders, who picks the right strategy for growth versus just growth for growth's sake, and fair valuations. Both management and valuations, I would say, is a very tricky area, and there are several nuances that are even hard to explain, on a presentation or even like over years. I think it's more a art than a science to get those last two pillars right. So with that, let me jump into industry. Right, I'll give you a very high view. The next slide is a little busy. It's basically talking about the worldwide household savings. What I'm looking at is basically there are three different data points which we're sharing here. We're sharing different countries around the world which have high savings rate as a percentage of GDP on the x-axis, and on the y-axis we have a 5-year CAGR growth rate, which is basically the last 5-year growth rate. And this bubble, which represents the current total savings, annual savings, of each country. So if you see, China and India are all the way here on the right, which means they have a high savings rate as a percentage of GDP. You can see that China is a little ahead of India, if you see the center of the ball. And also these are the two same countries which are the highest in terms of growth in savings over the last 5 years. China, India, and then comes Mexico. If you look at the quantum of savings, which are represented here in the size of the bubble in trillion US dollars, annual savings in China are close to 4 trillion US dollars. Right, so that means it's the first, it has the largest annual savings in the world. After that, second comes the US, and third is India. So in terms of savings that the economy actually generates, we are third, which I think in very few things we are number 3 in the world. So this is one of them. So diving right into India household savings, I think we've heard this for many generations that Indians love to hold physical assets. Property is one of them, and gold and silver are two other financial assets. So here we just see the time period we'll be taking is FY12 to FY20. This is the last data we have, so we've just shared for FY18. How the trend's been moving. So financial savings, all financial instruments, whether it's equity, PPF, insurance, bank deposits, savings account, everything comes in this. So as of financial year 12, that's March 2012, 40% of all annual savings in the country were in financial assets, whereas 60% were in physical assets, which is property, gold, silver, etc. If you can see, the trend slowly changed, and in FY16 actually it tipped over. 53% was in financial savings and 47% was in property and gold. And then you can see that in FY17 actually something else happened, that it actually went down, the financial savings. And the reason I think for that was not demonetization should have actually made people move more towards financial assets, but maybe they just got a little worried, so they moved more into gold. So gold and silver do well in recessions, and so when people are not very confident of money making good interest or returns in the coming years, then people tend to shift to more physical assets. But then if you see FY18, the trend has again picked up, where again financial savings has hit 51%, and we see this trend moving up even further in the coming years. So this chart was at an aggregated level, at a total India level. But if you just drill down to what does an average household hold, right? So average household will typically hold something like this, which is 53 or 54% property, right? 11% gold, 16% bank deposits, 6% insurance, 5% TPF, 3% cash, and about 5% or 4.6% equity. So this is where I think the whole tussle is, right? Equity versus bank deposits. And if you attended our last week's seminar, we basically spoke about how bank deposits actually reduce your buying power over time, versus equities is the only long-term way to, you know, increase your purchasing power over time. So here we can just see that we'll basically be discussing these two financial assets. Bank deposits have been growing at 11% CAGR. Just 1 second, I think someone's waiting in the meeting. Okay. Yeah. So bank deposits, we can see, went up by 11%, right? Between, again, that same period, FY13 to FY20. Okay. They doubled in these 8 years, but a CAGR of just 11%, versus if you see the mutual fund industry, right, which is the main exposure people have from into equities through mutual funds, and that's our basic premise here. So between FY12 to FY20, you know, it's more than tripled in size, and that means the CAGR of 18%. Compounded annual growth rate is what CAGR stands for. SIP, if you see, you know, systematic investment plans, the monthly investments that a lot of investors do, that is actually even growing further. It's growing at 31% in the last 4 years. We don't have the same time period mentioned here, but you can see that it's really accelerating. Also, the fascinating thing is that monthly SIPs, you know, in the last 5 months since January, they haven't really moved. And, you know, a lot of these obviously have, these are long-term SIPs, 5 years, 10-year SIPs that people keep, and they continually invest, you know, all the salaried people. And even with COVID hitting in Feb end, you know, you can see that this has shown a lot of resilience. But in May, it has started waning a bit, and it'll be interesting to see, you know, with job losses and slowdown coming into the industry, if this wanes a little more. But so far, the data is really in our favor. So when you're looking at an industry, you know, what we are looking for is basically growth and resilience. And the mutual fund industry shows both of these, not just the Indian mutual fund industry, but, you know, even say other industries around the world. But more importantly, the monthly SIP, which gives us more confidence that, you know, people will continually invest in the equities. To understand the industry dynamics a little better, so if some of you have done economics, you know, you would have learned that some industries are just 2-player games or 3-player games. Those are either, if there are only 2 there, it's called a duopoly. If there's only 1 player, it's called a monopoly, right? If there's more than 2 players but just a handful, which is called a oligopoly. So essentially here, of course, there are about 40 mutual fund companies. So it's not really an oligopoly in a pure sense. But if you see the market share of the top 5 players, right? SBI, AMC, HDFC, AMC, ICICI Prudential, Aditya Birla, and Nippon India, you know, they account for 57% of the overall assets under management, which in a way shows an oligopoly at the top, right? Which means basically the big will be getting bigger. And this is even witnessed from the fact where, you know, there's a persistent increase in market share of HDFC mutual fund company over the last 2 years. So they had 13% of market share back in September 2018. So coming to the last leg of our research, valuations. So we look at a discounted cash flow model right, to look at what our company will be worth 5 years out. So what we expect is that HDFC will grow faster than the industry and capture market share. So just to walk you through these numbers, basically this is the industry AUM. So this is the total assets under management of the mutual fund industry in India, which is 22 trillion, right? And HDFC AMC has 3 trillion out of this, right? And so they currently have a 14.3% market share of the overall AUM in the industry. These are the historic numbers, projected numbers, 2021 onwards. What we are expecting is that the industry will grow at a 12% CAGR or annual growth rate, and HDFC AMC will grow at a 14% growth rate, which basically means that we'll be capturing more market share and we'll move to a 15.3%. I know the earlier slide said 15.3% is already there. So I think those are just numbers shared by the company, but they may have a different way of measuring that, and maybe they only take the segments in which they're present, whereas this is our calculation and this is what we'll be kind of tracking. So typically what value investing or long-term investing does is assumes that share price will follow profits. So share price will appreciate when profits go up, right? So what we are expecting is essentially, right now there are 20 billion in revenue and 7 billion in PAT, and in 5 years out we're expecting 35 billion in revenue and 13 in PAT. So that's almost double the PAT. And so if we say that double will be the profits, then which means we expect to double our money also in 5 years, which means 15% growth in PAT and share price, per year. So that's what we are expecting. From our DCF analysis, we realize that the current share price, is up close to 2,400. It's close to our base case, so we would say the company is fairly valued. It's definitely not cheap right now, but it meets our basic criteria of doubling our money every 5 years to meet our long-term investment objective, right? That's our kind of stated objective, which we are trying to work with. So when we look at a company, if it doesn't meet our industry growth, company growth parameters, then we try to avoid investing in those companies. Last but not the least, we have looked at multiples. Since there are only 2 companies listed in India, HDFC AMC and Nippon India Asset Management Company, and the multiples for Indian companies are obviously always very high compared to any other geography, mainly because of growth. We've also looked at PEG ratio, which is PE over growth for last year. So we can see that even between these two, Nippon Asset actually degrew a little bit last year. So we are actually at a 1 PEG ratio, which isn't too bad, and again indicates to a fairly valued, versus some of the other asset management companies globally, where you can see that the PEG ratio, PEG ratio is much higher, right? So with that brings me to the end of my presentation.